Well, happy Easter Tuesday. Um, Rather than bringing along a friend, I thought we would do this review of the exam, actually have the Easter Bunny do this. So I'm going to cut this into two parts. So the first part, we're going to review the multiple choice questions. And, you know, there's an old saying, I'm a New York Jet fan, football fan, and often there's a joke that says, I'm not a serious football fan, I follow the Jets. So Jets won one Super Bowl, one championship, and that was in 1969 of the 68 season. And their coach at that time was Weeb Ewbank, and he had one of the expressions that always stuck with me to this day, and it was that hindsight is always 2020. So when we look back, we could always see things that we could have done differently when we look back. So the format is pretty much stabilized now. You know, on exam number 3, it's going to be similar to exam number 2, that there's going to be a take-home part and there's going to be a multiple choice part. And I strongly, that was 3 stronglies, with the rabbit paw, 3 strongly request that you do those diagnostic questions and practice more with the multiple choice. And I think that'll bear much fruit when you actually get to the multiple choice part of the exam. So let's call up the multiple choice part, and I'll do a separate little video on the problem or take-home part. So again, you had 32 questions. So the way when you get your handout from me on the exam, you'll see I took the number right, divide by 32, and then multiply by 40. So the maximum you could have got on the multiple choice was 40 points. Each of the little take-home problems, with 6 of them worth 10 points apiece. All right, first question here. Now, when you take multiple choice questions, there's a strategy here. So you want to look for the answer that is the most correct. And some of them, there were a couple that had computations. So if we had computations, I'll actually show you what the computations were. So Airco Company is tempted to consider support department costs to be facility level costs that do not need to be applied to products. Which of the following explains what is misguided about this approach? So if they make the cost facility-wide, that means they're not applying them to the products, which assumes that all the products use the support department costs the same. And that's really not true, because support product costs may be inaccurate, because support department costs may be used more heavily by some products than others. So that, of all the answers given there, C is the best one, because as the support department's cost may be used more extensively by one product than the other. So to assume that they're all the different departments used in the same would be fallacious, incorrect reasoning. So the best answer there is C. Number 2, joint costs are inseparable before the split off. So before the split off, remember we had that example where we manufactured out of something from the mud, out of the river or Sea of Galilee in Israel. So then with the point, and then we split them off into face cream and other products. But joint costs that are costs that are inseparable before the actual split off. So the answer there is A. Which of the following are the 4 most common methods for allocating joint costs? Well, they are the market value at split off, physical units, weighted average method, and the net realizable value method. Nothing. Joint cost method is not a method itself. So for any of these answers that have joint cost, you can cross those ones off the list. So it's market value at split off, physical units, weighted average method, and net realizable value method. So the answer there is C. Number 4, under the net realizable method of allocating, which of the following equations is used to compute the value of products not processed beyond split off? So if you're not processing the product beyond split off, that means at the point of split off, its sales price is its net realizable value, because you don't have to consider any additional cost to get the product ready for sale. So the best answer there is A. Number 5, which of the following is a drawback using simple plant-wide rate to apply overhead costs to product costs? So if you use a single driver, that may not be correct, because the overhead costs are unlikely. There's unlikely to be one driver that actually applies to every type of overhead. This is why in the examples that we had some costs we allocate on the basis of number of employees, sometimes we allocate it on the number of square footage or some other measure here. So which of the following is the drawback of a single plant-wide rate? It would be that a single driver for all overhead costs is unlikely to deliver the selected appropriate for every type of overhead. So the answer there is B as in boy. Number 6, which of the following explains why it is difficult to apply support department costs such as janitorial cost to products? Well, the big challenge here is the coming up with the appropriate cost drivers. These can be difficult or sometimes impossible to determine. We could, A, B, and C, A, B, and D rather, are when contrasted to C, C is the one that is the most correct. Number 5, Woodbridge Incorporated manufactures food-grade wax-lined paper containers for the service industry for many popular restaurants. Which of the following is most likely a support department within Woodbridge? Well, deli container, sandwich container, salad container, those are product departments. So the one that is most likely to be a support department there would be B, janitorial department. Number 8, which of the following methods is true about the sequential method of allocating department costs to production costs? Let's take them one by one. The sequential method is also known as the step up. No, it's the step down method. C, the sequential method requires the same cost driver reused for each department. That's not true. Sequential method is less accurate than the direct method. No, it's just the opposite. So the best answer there is B. Sequential method catches some, but not all, the interdepartment costs by allocating support department costs to other departments in a series of steps. So the best answer there is B. Number 9, operating decisions of management focus on a narrow range of activity, and that is called the relevant range. The relevant range, the range within which we can figure out which costs are fixed and which ones are variable. We call that the relevant range. Number 10, the point where profit line intersects on the horizontal axis of the cost profit volume chart represents the break-even point. So that's where your revenue is equal to your total cost is the break-even. So the answer there is D. Okay, there's a couple here that had calculations. Piper Department Technologies, this is their fixed cost, $1,500,000. And they want to have an operating profit of $200,000. So it's the fixed cost plus the profit that they want. And you have to divide that by the contribution per unit. So the sales price is $250, variable cost of $130. So do the calculation, you come up with $14,167, which is A. Which of the following be classified as fixed costs for a T-shirt manufacturer? Well, electricity, hourly wages, cotton and polyester cord, those are all variable costs, so none of them are fixed costs. So the answer there is D, is in both. A, B, and C are all variable costs. 13, in a cost volume profit chart, total cost line does not begin at 0, it begins at the fixed cost. The slope of the cost line is dependent on the fixed cost per unit. No, that's not true. That's the variable cost per unit. So let's see C. So total cost line begins the total fixed costs on the vertical axis. That is true. Total cost normally ends at the highest sales value. That's not true. Okay, so the best answer there is C. And that's on the, get a look at your cost volume profit chart to see that one. 14, which of the following conditions would cause break-even point to increase? Remember, break-even point is fixed cost divided by the contribution per unit. So if the fixed cost goes down, that's going to reduce the break-even point. Unit selling price increases, that's going to reduce the break-even point. Unit variable cost decreases, that's going to reduce the break-even point. Unit variable cost increases. Well, if the unit variable cost increases, that is going to cause the break-even point to go up. So which of the following would cause the break-even point to increase? The answer there is D. As production increases, the fixed cost per unit goes down because we're spreading the fixed cost over more units. So the answer there is B as in boy. Which of the following is an example of cost that stays the same regardless of the number of units produced or changed? Well, that would be straight line depreciation. That's going to remain the same regardless of how many units that you make. All those other things there are variable cost. 17, which of the following is a reason for easy identification and control of variable cost under the variable costing method? Okay, variable and fixed costs are reported separately. Variable costs can be controlled. Fixed costs such as property insurance are normally responsibility. Those are all good choices for them. So those are all good reasons for the easy identification and control of variable cost under the variable costing method. So the answer there is D. 18, contribution margin ratio is contribution margin divided by sales. So the answer there is B as in boy. 19, the amount of income under absorption costing will equal the amount of income under variable costing when the goods manufactured actually equal the units sold. So you're going to have a difference between these two, and the difference is going to be in terms of which of the fixed costs are included in inventory. So under the variable costing and the absorption costing are going to be the same when the number of units manufactured is going to be equal to the number of units sold. So the answer there is B. 20, under variable costing, which of the following costs would be included in the finished goods inventory? Wages, steel costs, electricity, those are all, remember the cost of the inventory is going to include the labor, it's going to include materials, it's going to include overhead. So the answer there is D. 21, the amount of income under absorption costing will be more than income under variable costing when the goods manufactured exceed the units sold. And the reason for that is because if you manufacture more goods than you sell, you've got fixed cost that's included in the inventory. So the answer there is A. 22, on the variable costing income statement, the figure representing the difference between manufacturing margin and contribution margin, that would be the variable selling and administrative expenses. 23, which of the following would be inappropriate activity base for the analysis in a service firm? Well, a service firm, you don't have any inventory. So it would be inappropriate to include an inventory produced as part of your activity. Lawnmowers, you got a lawn mowing service, customers served, haircuts, those are all appropriate activity basis in the service, but anything to do with inventory would not. Which of the following is required by generally accepted accounting principles? Generally accepted accounting principles requires absorption costing. All right, this one requires a calculation. You're trying to decide how many units of merchandise to produce each month. The company policy is to have 20% of the inventory of the next month's sales in inventory at the end of the month. Projected sales for August, September, and October are 30,000 units. The number of units that must be produced in September is, so September, we're focusing on September, where we're going to produce 20,000 units. So you're going to have 20,000 units, plus you want to have 20% of the next month's, and the next month's number of units is 40, so 20% of that is 0.20 times 40,000. And then you're going to reduce that by your beginning inventory. Well, you're going to have 20% of the number you're going to produce that month in beginning inventory. So it's 20,000 plus 0.2 times 40 minus 0.2 times 20 gives you 24,000 units. See, whenever you do these calculations, do the calculation first and then go looking for that amongst the answers. Okay, for this one, sales revenue is $1 million. Sales commissions are 5% of sales. Sales manager's salary is $80,000. Advertising is $65,000. Shipping is 1% of sales. Miscellaneous expenses are $2,100 plus 1% of sales. The total selling expenses are going to be, well, the total selling expenses, 5% of 1 million is 50,000. Sales manager's salary is 80,000. Advertising is 65,000. Shipping expense is 1% of sales. 1% of sales is again 10,000. Miscellaneous selling expense is 2,100. And plus 1% of sales. 1% of sales is another 10,000. So your answer there is 217,000. See the calculation. 27. Company is preparing its cash budget. The cash budget balance on January 1st is 29,000, and its minimum cash requirement of 340,000. The following data has been provided. Okay, so what they're asking here is the amount of deficiency after considering the minimum cash balance for the month of January is. So in January, we started out with 29,000. We had 1,061,200 in cash receipts. We had 984,500 in cash payments, which gives us 366,000 at the end of the month. Our minimum cash requirement is 340. So we're actually in excess of that amount by 26,700, which the answer is A. 28, which of the following is an integrated set of operating and financial budgets for a period of time? So the operating budget and the financial budget combined is what we call the master budget. The answer there is A. Disadvantage of static budgets. Static budgets don't have any variety in activity levels. So a disadvantage of them is they do not allow for possible change in activity levels. So the answer there is C. Which of the following estimates the number to be manufactured to meet budgeted sales and desired inventory levels? We call that the production budget, so that is C. And 31, which of the following should be ignored when preparing the cash budget? Depreciation. Depreciation is a non-cash expense. And then 32, the primary budget in a non-manufacturing business would be the staffing budget. Okay, so that concludes the review of the multiple choice questions. I hope you found that useful. And come back and we'll go over the answers to the problems. And again, for exam number 3, please spend a bit more time doing those multiple choice diagnostics at the beginning or end of each chapter. You'll see it in there in the online materials, the support materials. Right, until next time, the Easter Bunny wishes you well, and we'll come back for part B. See you later. Hasta luego, au revoir.